Cisco was a classic name where they were in the right time at the right spot. They were in the internet era. They were one of the best players. It was a structural theme. But if you invested that in around 1999 or 2000, you would have just broke even right now. And the reason was because the entry level really, really matters. And price earnings ratio is just a number. It can be high, it can be low, but it's all relative. Essentially, what are you paying for X? And that X to me is growth.
How do you think about the valuation when you think about growth investments and trying to squeeze the lemon or trying to make more return? Welcome to episode 2 of our portfolio construction series. This is probably the most fun part because we're going to be talking about the growth part of your portfolio. How do you build that out? What's reasonable, what's not? We've got Billy Leung, absolute expert in ETFs and growth investing and technology. He's joining us for this episode. And at the end, he's going to share some ETF names that you can pop on your watch list. We've got so many examples to get through, but I have some really good educational questions to put to Billy to help you build your own portfolio properly. Billy, how you doing?
Good. How are you?
Very good, mate. Very good to be talking about growth as an overall thing in a portfolio.
Yes.
I think this is, if we've got our series, this will be the episode that's most watched because I think that this is the stuff that people really like.
I hope so.
And, so no pressure. Don't let us down, but no pressure. So we're going to talk a little bit about what goes into a growth portfolio, the mechanics of why growth happens. So like, how does the growth actually occur and why does it occur and what should we be looking at? And then we're going to end with a few ETFs that we can pop on people's watch lists. My first question is, like most people, when they think about growth, they say, I want to achieve a return or something like this. But how does it actually occur? Like when you think about a good portfolio, I guess maybe I frame this the right way is, what does a good portfolio look like in terms of growth assets? And then we'll peel back a layer from that.
Yeah. So, I mean, look, this is obviously, we can go very high level and we can go so really deep. I mean, on a high level, looking at a portfolio which is maybe tilted more towards growth is essentially about asset allocation. I guess one of the most clearest ways to express growth is probably having a higher allocation or increased allocation to equities. Yeah. And we know equities generally have higher growth compared to defensive products like, your fixed income or even commodities at one stage in the history. But I think that tilt is probably one of the first things that investors should look at. If I'm looking at growth, how much tilt should I look into equities? And I guess the second part is, if we're looking into equities, how are we getting exposed to equities? Is it through ETFs? Is it through even single stocks? And at the end of the day, how growthy also depends on whether or not you actually want to leverage on it. So I think just very high level, it's more about asset allocation. And then we probably funnel down in terms of what specific growth do you actually want. It's
really interesting because your background is like globally, you've been all over the world and researched companies, like individual stocks. And now you apply your craft to ETFs. Yeah. Would you say that most people that you come across now are using ETFs first and then individual stocks second? Or like, how do you think that's gone over time?
Yeah, that's a good question. I think interestingly, I wouldn't say one is more than the other, but I would definitely say that there's more and more people tilting towards ETFs. And I think there's several reasons for that. It's much easier to understand now. There's more education around it. It's much more prevalent. Yep. It's much more accessible. And at the end of the day, I think we've got much more transparent ETF products right now. And not just our firm, but various firms as well. And I think to your question is, yes, I looked at stocks before, but at the same time, when we do look at stocks, it's also a very high level as well. We look at the theme, we look at if it's investable, and then we look at the stock. So it's whether or not you go through a bottoms-up approach or a top-down approach.
Yep. If someone was like probably shrewd and watching or listening to this, they'd probably say, well, on average, stock markets, give or take, tend to return somewhere between, say, 9 and 11% per annum, like the broad stock market. But they might think, well, maybe I can get a bit more than that. Like if they wanted to squeeze the lemon, so they wanted to get more from their growth part of their portfolio, how would they do that? Like in theory, at least.
Yeah, so this is where it gets, where we will funnel down from asset allocation to, where you're actually allocating that growthy part, which will focus on being equities. And I think a good example is, like you said, equities has been returning on average 9 to 10%. Yep. How are we going to beat this 9 to 10% or even allocate more? And I would say, first thing, maybe look at geographic. I think that's probably the first thing. And I think one thing that Australian investors have to realize is that the Australian market, while big, is only 2% of the global stock market. And if you look at the US, it's about 65% of the global stock market. So we are missing out on a large chunk if you're just investing domestically. One other thing Australian investors need to realize is that most of the industries in the Australian stock exchange are financials and mining companies, which generally don't reinvest. They actually distribute their profits. And what that means is that there's no compounding effect in terms of these companies. They don't technically grow. They're actually distributing their profits. Compared to the US economy or even the global economy, where there's relatively more tech stocks, they actually reinvest their earnings into growth, and which means there's more compounding and potentially more growth. And again, which is why the US, to an extent, has been one of the fastest growing markets. So to answer your question, maybe to look at growth, it's also about geographic, looking outside of Australia, and B, is to look at the sector as well. Are these sectors, are these companies actually reinvesting, which means that you'll actually get the compounding of growth rather than just the gradual distribution of earnings.
Global X is a leader in commodity, thematic, and specialized ETFs. Global X has been a partner of Rask for many years, and I'm so excited to witness their rapid growth over that time. Their range of ETFs, in-depth research, and focus are all designed to help you invest better. Visit globalxetfs.com.au and tell them Rask sent you. I'm hearing a lot of investors asking the same question. Where can I find reliable income in this market without taking equity market risk? That's where Term Plus comes in. It's designed to maintain a steady buffer over the RBA cash rate, providing regular distributions and somewhat of a cushion and diversification on your passive income. To find out more about Term Plus, simply search for Term Plus or head to termplus.com.au where you can find the PDS and TMD. And don't forget to tell them Rask sent you. This episode is brought to you by Stripe, helping your business be ready for whatever comes next. And the next shift in how people buy is already happening. Agentic commerce lets customers discover and purchase directly inside an AI conversation. No checkout page, no friction. The businesses positioning themselves now are the ones who will lead this channel. Whatever comes next for your business, power it with Stripe. Learn more at stripe.com. That's really important. A really good point is the companies can retain their profits and then keep investing in themselves rather than giving dividends out or distributions in the form of ETFs. If you're interested in income, we are going to talk income in the next episode, so don't worry about that. One thing that I see with individual investors, not so much with financial advisors, but with individual investors, they can sometimes get swept up in the idea of chasing returns. So they can see one ETF do so well or another ETF. Maybe it's got, I think there was one ETF from Global X that did like 100% last year, which was, I didn't even realize this at the time. I was like, wow, that's like incredible. But I kind of know that that's maybe not sustainable for forever, right? I know that there's kind of some level where I'm like, that seems like it's good, but maybe it's not going to happen this year coming. Yeah. So I guess one of my questions to you is, how do you know whether the growth that you're getting from an investment, say if it's an ETF, is sustainable or not? Like, where do you kind of draw the line?
Yeah, I think that's a tough question as well. But yeah, you're right. We have several funds which have, been over 100% in the past 12 months, copper funds, even, something more extravagant like the hydrogen fund as well. They've done really well. And to answer your question is that it's all about looking forward looking. And you're right. When you look at funds or even any assets that has increased quite a bit, a lot of the times it's been pricing in some sort of the future. Yeah. And so in order to actually understand whether or not this is sustainable, what we have to understand is how much is the current pricing on its growth. So for example, when I looked at one of our funds, for example, the defense technology fund, and on paper, it looks very expensive. People look at it and they go, oh, the PE is very high, the price earnings ratio. But actually when you look at it, and again, this is a little more technical, but then when we worked out or back tested or backtracked it, it actually implied a growth to the next 10, 20 years of about 10 to 11%. And it didn't seem that expensive because we're looking at a defense technology thematic, which is potentially going to grow at much faster rates. So I guess for a lot of investors, it's really important to think about, yes, something has gone up a lot. Can it sustain? Depends on, whether or not you believe that this industry, this thematic or this sector or this country can grow at X% in the next few years. So I think it's about breaking down whether or not the future growth is sustainable.
So we're recording this in mid-2026 for anyone that's watching later. Last year, you and I did an episode on AINF, which is one of the global X ETFs that targets AI infrastructure. That ETF has performed exceptionally well.
Yeah.
And actually, people listen to the podcast, Billy, believe it or not, and they actually bought the ETF. And I was
nice.
like, read
good.
the PDS and, all the usual disclaimers. That's a good illustration, I think, too, of my next question, which is people go into like thematic ETFs, which are based on like themes like AI or robotics or so on and so forth. Hydrogen, as you mentioned, is somewhat like that. That's one way where people think, I'm not going to just take the broad stock market. I want like a particular type of industry that I think is going to do really well. How do you think about where those industries are in terms of their growth phase, whether they're more speculative, like early stage, whether they're more mature? Like, how do you kind of frame that?
Yeah, so I think in some ways it's trying to how to identify like maybe a structural theme or maybe identify a longer theme. And I think there's a few things. I think you have to first realize whether or not this theme or this industry, is it recession proof? I think one of the classic examples is the cloud computing. We saw cloud computing develop in the last 15 years. It's gone through different cycles, but there was structural demand for this product, and this actually came through as well. And somewhat, this is how we feel about AI. There is actual structural demand. It is technically recession proof. And I think another good example is during the past Middle East conflict, which has been very volatile. It created a lot of uncertainty. One of the best performing themes was actually semiconductors. And that's because people realized that was actually the safety net or the safety area, because the structural theme of semiconductors will not change independent of what happens in the Middle East. And I think this is something we have to consider.
Is that because, just Billy on that, is that because people need more technology and more like, because those semiconductors go into computers, they go into AI, they go into everything that we use. Is that why?
Yeah, definitely. I think semiconductors is a very interesting industry, and sorry for going sidetracking, but semiconductor, and I've covered this for about 15 to 18 years, semiconductor used to be a relatively boring industry where it's cyclical and it just follows the PC, smartphone and laptop cycle, and it follows that cycle. And what we realized about semiconductor recently was that trend of following the demand of PCs and smartphones and whatnot has actually broken. It's actually growing much faster than all these other consumer electronics. And the reason for that is because of AI. Like you said, there's data centers now. There's an incremental demand for semiconductors, which I think makes semiconductors no longer a cyclical trend. It's now actually more of a structural trend.
Got you.
So I think that was a very interesting observation during the conflict where semiconductors just rallied despite any news. I think the second thing we have to realize when we look at a structural theme is that whether or not, it's, a theme that, gives profit to investors. And I think a really good example is back in the days, one of the biggest revolutions or evolutions was airlines. Airlines, there was air travel. But interestingly, if you look at airlines is actually value destructive. Because of competition, they actually give most of the profits back to consumers and not to shareholders. And I think, interesting aspect is whether or not, this theme is a structural trend, structural demand, and B, whether or not it's actually rewarding its investors rather than just giving it out to its, end users. It's
interesting because airfares for the most part have got cheaper, right? When you think about it, like over the decades, you can now get super cheap flights here in Australia or overseas if you really want to. Yeah. And the planes are still the same planes, right? Yes. When you think about it, they're still flying into the same airports.
So it's very important to identify. And I think on the other side of the good example is actually EVs. EVs got cheaper. People thought that these companies will not make money. But actually, if you look at all the EVs companies ranging from US to even China, they're actually increasing their profit margins. Yeah. So I think, we have to look at two things, whether or not, are they giving that profits back to investors? Yes. And that's really, really important.
Yeah, that's good because you can, I guess that signal of cheaper equals less profit is not always the case, right? Because
exactly.
BYDs, Teslas, these cars are getting cheaper over time, but the companies are getting bigger.
Exactly.
Yeah, of course. That's great. So I've got a couple of questions here for you. Is one, if an investor was thinking about building the growth part of their portfolio, and I'm going to use ETF because most of the community use ETFs as the basis for their portfolios, but you can take this however you like. Where would you start? And I'll frame this a bit better. It's like, where would you start? Would you start with a broad growth ETF or would you start like with these types of things that we're just talking about, more like the thematic stuff? Where would you start?
Yeah, I think just from a growth perspective, definitely more of a broader growth. Again, if you have a very large view on a big theme like AI, start with the big AI universe.
Yeah.
And then maybe funnel down, the AI is very big, it has different parts, different value chains as well. And then you go into it, whether it's AI, you like the semiconductor industry, AI, you like the software names, AI, you like the infrastructure names. I think then you funnel down into it. And I think that's sort of what creates a nice blend in the growth part of the portfolio. And then you can even go further. I think, there's maybe like specific parts of the semiconductor industry, specific parts of the software, whether it be cybersecurity. I think that's when you funnel down and really try to, I guess, like you said, try to get that really additional growth.
This podcast is proudly brought to you by Pearler, the official brokerage platform of Rask. With Pearler, you can effortlessly automate your money, whether you're investing in ETFs or shares from Australia or the US stock market, whether you're a grandparent or setting up a kid's account or your own account. You can do all of that with full automation on Pearler.com. If you want to learn more, head to Pearler.com/Rask. And of course, before you invest in anything, be sure to read the legal documents like the PDS and FSG. Thanks for watching this Rask podcast. I want to tell you a story about how the new Rask platform came to be. In 2025, everyone was still waking up to this idea that AI was going to have an impact on the world. And it wasn't until mid to late 2025 that it really hit me like a ton of bricks. At that time, I thought, what can I do with this new tool, this innovative technology? That set in motion what has now become a totally new Rask platform, which you can find at rask.au. It is 100% free to create an account and start using tools. But what did it actually do, and what does it do for you? At Rask, we've produced thousands of podcasts, probably 20,000 articles we've written on investing and all of these different types of things like personal finance, superannuation, you name it. So we really needed a place where we could bring all of that together for the entire community. But once we built the platform, we realized that that wasn't enough. So in 2026, we've decided to launch a new community known as the Rask Ultra community. This is the deepest, most advanced part of what we do as a business and as a community of investors and builders. We want to build a network of people that can come together and share ideas in a new ecosystem that we've built just for you. You can find out more, like I said, by Googling Rask Ultra or by creating a free account at rask.au and see if Ultra is right for you. Yeah, that makes sense. I always think it's prudent for people to start broad and then kind of learn what it's like to research and develop their understanding. And let's be honest, like a lot of companies and consumers are going to benefit from AI. Regardless of whether they're, got a 10 stock portfolio or a 100 stock portfolio, they're probably going to get some exposure to it just from the benefits from it.
Yeah, that's a good point, Owen, because one of our funds, the Global X Artificial Intelligence ETF, GXAI, has 85 names globally. And I think last year there was one question from a client saying, hey, it's really interesting. You actually have 2 Chinese names in the top 5, which is Alibaba and Tencent. And I think that's when they came and asked me about, hey, what do these companies do? And I think that was exactly a really good learning outcome as well, where, they were invested in a big theme that they believed in, but suddenly the stock appeared in the ETF where they weren't familiar with, and they looked into it and they go, wow, China's doing all this, and that actually spurred their interest and actually go, hey, maybe we might look at China AI, and they didn't realize how big that AI industry was there.
Yeah, that's such a good point, because I think that's the benefit of a lot of those ETFs, right? Like you might have a view that like, oh, I think the US is the mecca for AI and I should only invest there. But then you could be completely blindsided about this other thing that's happening over the other side of the world, which is where all this stuff gets created. And there's so many things, good things happening over there. Whereas an ETF gives you that kind of basket where, hey, it's rules-based, but you might miss these if you're not invested there. And this rule captures those companies and brings them in, which is so important.
And that even happens on a professional level as well, because even one of my bigger, larger, and smarter clients, they were interested in semiconductor, but they bought a fund, an ETF in the US, which was just purely US semiconductor names. And then afterwards, they realized, why is it underperforming a lot of the semiconductor ETFs? And the reason was because it was purely US and it didn't include the Korean and the Taiwanese names, which were the outperformers. So this happens even on the higher end scale as well in terms of education.
Yeah, because you kind of go so narrow that you might miss the broader opportunity set. You did mention something before where you talked about valuation. You mentioned, I can't remember which ETF you were referring to, but effectively you said the price earnings ratio. So the valuation metric seemed high.
Yep.
And you can view this on the Global X website. You go in, click on the fact sheet, and you can see all the portfolio analytics, and it's also on the website there. But like people may be inclined to think about valuation, Billy, because they might be like, well, have I missed the boat on ... thing?
Yeah.
Or is the market too expensive? How many times have we heard that? How do you think about the valuation when you think about growth investments and trying to squeeze the lemon or trying to make more return? How do you weigh that up against the valuation?
Yeah, I think it's a little tough one because sometimes it gets a little technical, and it goes both ways. Oh, and I think one of the permanent examples of valuation being an issue while the theme was correct was, if you remember, Cisco. Okay.
Oh, yeah.
Cisco was a classic name where they were in the right time at the right spot. They were in the internet era. They were one of the best players. It was a structural theme. But if you invested that in around 1999 or 2000, you would have just broke even right now. And the reason was because the entry level really, really matters. And why I say that is because, yes, there is a lot of growth coming from a structural theme, but it's also about, where you are coming into it, that sort of timing as well. It is important. And when we look at a lot of things, and like you mentioned, you flag that price earnings ratio, which is really important because price earnings ratio is just a number. It can be high, it can be low, but it's all relative. It's essentially, what are you paying for X? And that X to me is growth. Yeah. So what's important is, and I think that's a good example in terms of the AINF or the Global X AI Infrastructure ETF, is that it's probably trading at about 25 times earnings. And people might think that's much more, that's really expensive because it's higher than S&P 500. Yeah. But if you look at the growth, AINF is expected to grow at about 40 to 70% in the next few years, whereas the S&P is expected to grow 10% per annum. So I think it's really important to go, yes, you might be paying a high PE, but for what? Growth. So it's more of that sort of, what are you paying that bang for buck?
Yeah, so just to clarify for people's understanding here, it's you're saying like this is the profits of the companies inside the ETF, how fast are they growing?
Yes.
And depending on how you cut it up, you could get a basket or an ETF that's got faster growing companies inside it.
Yes.
So you're happy to pay a higher price for those.
Yes.
That's actually probably like, that's how I should have just asked that question to begin with, because that's kind of the essence of it, right? Like you say, it is more in depth and advanced in some respects, but it's ultimately about what are you getting inside of this ETF?
Yes.
And how does that then fit into your portfolio? Speaking of, so I had a list of some of the ETFs. I'm going to get you to name some of your ETFs in a second that people should put on their watch list as we close out. I was thinking about how we can make this episode really practical for people. Mark's going to come on in the next episode and talk about income and defensive side as well. And then Jess will come back on the show and talk about like the actual math and stuff behind putting a portfolio together. But I wanted to imagine that you had a client that might have like a 50-50 portfolio. So they got 50% in their growth part and then 50% in their defensive part. I was just thinking like, this is not personal advice, of course. I'm just thinking like higher level. How do you think about weighting ETFs? Because like you've got in the range at Global X, you've got A300, which is Australian shares, 300 companies. U100, which is 100 US companies, so big tech companies and all that sort of stuff in there. But then you have more concentrated ones like FANG, which is 10 companies in the US, big companies, but 10. I guess I'm just after like a broad assessment of how those types of ETFs go into a portfolio in terms of their weightings. So like what would a sophisticated or professional investor like yourself say is like a suggestible range of weightings? Does that make sense?
Yeah, look, it'll be tough to give you exact numbers, but I think a good concept to look at in terms of how much to weight is, probably looking at, the concentration is a very good example. When there's a very concentrated portfolio or product or an ETF, you wouldn't want to put, all that high weight onto it. So I think it's maybe like an opposite inverse relationship where, if a portfolio is larger, you might potentially also have a larger weighting. Whereas, for example, if a portfolio is more concentrated, you might consider lowering that weight as well or exposure. And I think it's very intuitive. You technically all that thing about don't put all your eggs in one basket. I think it's a very good, starting concept to know that concentration may be a smaller weighting, more widespread or, more diversified or larger holdings, maybe a larger holding. And I think that will be a really good starting point.
Yeah, I like that. So it's kind of like the inverse relationship. So something like FANG, which is 10 companies, may have a smaller weighting, but it maybe I think about it maybe a bit like cordial. It's kind of like the concentrated version of cordial. Like it's like you don't need to put much in to get a good result.
Yes.
Right? Whereas you've got like the diluted, mixed down version.
Have more of that.
Yeah, you can have plenty of that and you'll be fine. You'll still be able to sleep.
Yeah, so I think that's a good starting point, but obviously, during different phases, you might want to tilt against it. But I think that will be a very good starting point in terms of how to look at concentration and portfolio weighting. Yeah,
cool. I like it. So now I'm going to test you or ask you for 3 growth ETFs that people could put on their watch list. So these are not like buy, hold, sell, but more so like people that are watching or listening want to build a portfolio that is reliable, dependable, long-term focused. But they may not know where to start. Like which ETFs would you say, if you're building out your growth sleeve of your portfolio, what names would you start researching first?
Yeah, I think, look, we've talked about AI a lot, and obviously you know that I'm very, very, convicted on AI. I think it's just the start of the whole thematic right now. So I definitely think that all investors or most investors need to have AI exposure in some way. And one that I think that's worth researching is one that I mentioned during the show was the Global X Artificial Intelligence ETF or GXAI. And what we like about it is because it's global. It's 85 names global, including US, Asia, Europe, even parts of Japan and Taiwan as well. So it's a global fund, and it's across different sectors of the AI. So it includes semiconductors, it would include your data center operators, it would also include the adopters or the enablers as well. So it's across the segment, which I really like. And internally we call this the lazy way to get exposed to global AI, and I think it's very nice. So I think that would be the first one that I would share and flag with investors to look at. Just going down that funnel, we've been thinking about the major, beneficiaries of all this AI spending. Hyperscalers are spending over $800 billion this year, and we're thinking, who are the real beneficiaries, or who are the second order beneficiaries? And we believe it's the AI infrastructure players. And these are not your data center names. These are the picks and shovels behind data centers. All the companies that are providing the electrical equipment, the cabling, the cooling equipment to data centers, which is the whole theme of the Global X AI Infrastructure ETF, AINF.
Yep, like it.
And then the final one when you funnel down is actually when you look at what we've talked about is, which other areas are actually developing AI that we don't have exposure with. We've got exposure to US, we've got exposure to Asia, but we need to look at China as well. And I'm sure everyone's been reading headlines about how Chinese AI, large language modelings, are now catching up or even overtaking its Western counterparts. We've seen the China stack in terms of AI really developing. They've got semiconductors now, they've got foundries, they've got optical components, they've also got, obviously large language models. So I think this is an area where investors also need to pay attention to. So this is where we would flag our Global X China Tech ETF or Dragon, DRGN. So these are probably the 3 which I think aligns with what we talked about. Some are concentrated, some are wide, some are geographically dispersed, some are focused on geographic. And I think this is a really good mix to start off with, just to think about that growth profile.
I like it, mate. So we've got GXAI, AINF, and DRGN or Dragon, probably one of the best ticker symbols or stock codes on the ASX for sure. So these are going to go firmly in the growth camp. These are they're both exciting, and the companies are many of them are really developed and robust companies that have been around for a long time. Global exposure there, mate. Well, this has been really insightful for people and really helpful, I hope. If you're watching this or you're listening to this and you want to kind of name some of your own ETFs, chuck them in the comments and I'll come and have a read. But mate, always a pleasure to have you on the show. Thank you for sharing some of your wisdom. And once again, thanks.
Thanks for having me.
I regret to inform you that Chances are, a lot of you will need financial advice. Since we started the Rask Advice business, I've noticed quite a few trends, but one of them is the importance of having confidence in what you're actually saving towards or investing towards. A lot of people in the Rask community are very capable of managing their own money, but when it comes to critical points in their life, like retirement, selling a business, scaling a business, getting married, buying your first home, so on and so forth, getting expert advice will actually save you from a bunch of mistakes and give you the confidence to know what it is you're doing and why you're doing it. If you want to get matched with one of the trusted financial partners that we have, you can just head to rask.au/financial planning, or you can get in contact with us on any of the Rask websites. Not only does Rask itself provide financial advice, but we also have trusted partners if we're not the right fit for you, so we can help guide you in the right direction. And that in turn supports us to create more free financial education content like podcasts, courses, and so much more. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.